Here's a number that should bother you. The average American with a W-2 job pays a higher effective tax rate than plenty of people worth 8 and 9 figures. Not because the rich are breaking the law, because they're using the law better than everyone else. ProPublica once analyzed EARS data on the wealthiest Americans and found several billionaires paid a true tax rate in the low single digits relative to how much their wealth actually grew in a given year. That's not a loophole in the sense of a mistake in the tax code. It's the tax code working exactly as written, just used by people who understand it. Today I'm breaking down exactly how the top 1% structure their businesses to legally shrink their tax bill. 10 strategies, step by step, so you can see which of these actually apply to you. Quick note before we start, none of this is about hiding income or fudging numbers. Every strategy in this video is written directly into the tax code, and most of it has existed for decades. The tax code isn't one flat rulebook that applies the same way to everyone. It's closer to a set of incentives. Buy certain assets, and you get a deduction. Save for retirement a certain way, and you get a deferral. Structure your business a certain way, and you change how your income is taxed. Wealthy taxpayers and the professionals they hire simply follow those incentives more precisely than the average person ever gets shown how to. If you find this useful, hit like and subscribe. It helps this channel keep making videos like this. The first move almost every high earner makes has nothing to do with clever paperwork. It's choosing the right business structure before the money even shows up. Most people default to a sole proprietorship because it's the path of least resistance. No forms, no fees, just start working. But a sole proprietorship means every dollar of profit is hit with self-employment tax, currently 15.3%, on top of ordinary income tax. The 1% mostly don't operate that way. Once a business is consistently profitable, many elect S-corporation status. Here's the mechanic. As an S-corp owner, you pay yourself a reasonable salary, and that salary is subject to payroll tax. But any profit above that salary can be distributed as a dividend, and dividends aren't subject to the 15.3% self-employment tax. Concrete example. Say your business nets $150,000 in profit. Pay yourself a reasonable salary of $70,000. That's taxed normally, payroll tax included. The remaining $80,000 goes out as a distribution, avoiding self-employment tax entirely on that portion. That's a difference of over $12,000 in tax, just from entity choice. Now scale that up. At $500,000 in profit, the gap between everything taxed as self-employment income and salary plus distribution can run into the tens of thousands of dollars every single year. That's why you'll almost never find a 7-figure business still filing as a plain sole proprietorship. The entity structure alone is often the single biggest tax decision an owner ever makes, bigger than any individual deduction on this list. One caveat worth knowing, the EARS does scrutinize reasonable salary. Pay yourself $10,000 on $500,000 of profit and call the rest a distribution. And that's an audit flag, not a strategy. The number has to reflect what you'd realistically pay someone else to do your job. It's also worth understanding why so many businesses start as an LLC before ever touching S-corp status. An LLC by itself isn't a tax classification, it's a legal liability shield. By default, a single-member LLC is taxed exactly like a sole proprietorship, and a multi-member LLC is taxed like a partnership. The S-corp election is layered on top of that LLC, which is why you'll often hear people describe their setup as an LLC taxed as an S-corp. Two separate decisions. One for liability protection, one for tax treatment, stacked together. Second lever, retirement contributions, used far more aggressively than most people realize. A W-2 employee maxing out a 401 can shelter a little over $23,000 a year. A self-employed business owner using a solo 401 can contribute both as the employee and the employer, pushing total shelter room past $69,000 a year, all pre-tax, all growing tax deferred. Some go further with a defined benefit plan on top of that, which, depending on age and income, can shelter well over $100,000 a year. This is one of the most underused strategies among ordinary business owners, mostly because nobody tells them it exists. There's also the backdoor Roth strategy, used constantly by high earners who technically make too much to contribute to a Roth IRA directly. The move is simple on paper. Contribute to a traditional IRA with after-tax dollars, then convert it to a Roth shortly after. Done correctly, that money then grows completely tax-free for the rest of your life. No tax on withdrawals in retirement at all. For business owners with the right plan design, there's an even larger version of this called the Mega Backdoor Roth, which can allow tens of thousands of additional dollars into Roth-style accounts beyond the normal limits by routing after-tax contributions through the plan and converting them. It's more complex to set up correctly, which is exactly why it's more common among owners with an accountant actively managing their plan design rather than someone filing on their own every April. The common thread across every retirement strategy on this list: the tax code rewards patience. Every one of these vehicles is built around money staying in the account for years, sometimes decades, before it comes out. That's the trade. You give up some liquidity today, and in exchange the government lets a much larger share of your money grow without the drag of annual taxation. Third, a deduction that quietly saves pass-through business owners a significant amount every year, and most people have never heard of it: the Qualified Business Income Deduction, or QBI. Under this provision, owners of sole proprietorships, partnerships, and S-corporations can deduct up to 20% of their qualified business income before it's even taxed. On $200,000 of qualified income, that's a $40,000 deduction, straight off the top, before you even start applying other write-offs. There are income limits and industry restrictions. Certain service businesses phase out at higher income levels, which is exactly why this is worth planning around rather than discovering by accident in April. Structuring income, timing bonuses, and managing taxable income near the threshold can be the difference between qualifying for the full deduction and losing a meaningful chunk of it. Fourth, the home office deduction, and a lesser-known cousin of it called the Augusta Rule. The home office deduction lets you deduct a portion of your home expenses, mortgage interest, utilities, insurance, proportional to the space used exclusively for business. Most people either skip this out of audit fear or claim it wrong. The Augusta Rule is more interesting. Under IRS Section 280A, you can rent your own home to your own business for up to 14 days a year, for board meetings, planning retreats, filming content, completely tax-free to you personally, while your business deducts the rental expense. It's named after homeowners near the Masters Golf Tournament who legally rent their homes out for a week a year, tax-free. Business owners use the same provision year-round. To be clear on the mechanics, you need to document a legitimate business purpose, pay yourself a fair market rental rate for comparable local venues, and keep records, meeting minutes, and invoice a comparable rate quote. Skip the paperwork and it stops being a strategy and starts being a red flag. Fifth, depreciation, especially through real estate. When a business owner buys equipment, vehicles, or property, the tax code allows them to deduct a portion of that cost every year as the asset wears out, even if it's actually gaining value, like real estate often does. Combine this with a cost segregation study, which breaks a property into components that depreciate faster. And it's possible to generate a large paper loss in year one, a loss that can offset other income. This is a major reason many wealthy individuals move surplus income into real estate, not just for appreciation, but because the depreciation schedule itself becomes a tax tool. There's a further layer for people who qualify as real estate professionals under EAR's rules, generally meaning real estate is their primary occupation, and they spend a substantial number of hours in it each year. For them, those paper losses from depreciation aren't limited to offsetting only real estate income. They can offset ordinary income too, which is a major reason some high earners restructure their careers around real estate entirely. Sixth, and this one has nothing to do with deductions at all, where you're legally a resident. State income tax rates vary enormously. Some states charge over 10% on top of federal tax, while several states charge no state income tax at all. For a business owner with flexibility in where they live and operate, formally establishing residency in a lower tax or no tax state can be worth more every single year than most of the deductions on this list combined. This isn't as simple as buying a second home and calling it done. States are aggressive about auditing residency claims for anyone who leaves a high-tax state. They'll look at where your driver's license is registered, where you're actually spending the majority of your days, where your doctor and your gym membership are. Real residency change requires real documentation, not just paperwork. Seventh, income shifting through family employment. If your children do legitimate work for your business, social media, filing, basic admin, you can pay them a reasonable wage. That income is taxed at their tax bracket instead of yours, and if structured correctly, it can also fund a Roth IRA in their name, decades ahead of when most people start saving. This only works if the work is real and the pay is reasonable for the work performed. The EARS does look closely at this one. Eighth, health-related deductions. Self-employed individuals can often deduct 100% of health insurance premiums for themselves and their dependents, paired with a health savings account, which offers a rare triple tax advantage. Contributions are deductible, growth is tax-free, and withdrawals for medical expenses are tax-free. This becomes a long-term shelter many people never fully use, especially since unused SOF funds simply roll over and keep compounding, year after year, unlike a flexible spending account. Ninth, charitable giving, done strategically instead of casually. Most people give to charity in small amounts throughout the year and get a modest deduction if they itemize at all. High earners often use a donor-advised fund instead. They contribute a larger lump sum in a single high-income year, take the full deduction immediately, and then distribute the money to actual charities over several years afterward, on their own timeline. Some go further by donating appreciated stock instead of cash. Doing that means never paying capital gains tax on the appreciation, while still deducting the full fair market value of the donation. It's a strategy that helps the charity just as much, while being meaningfully more efficient for the giver. There's a version of this specifically for business owners planning a future sale, donating shares of the business itself to a donor-advised fund or charitable trust before a sale closes. Done well in advance and with proper valuation, this can reduce the taxable gain on the eventual sale while still directing significant value to causes the owner cares about. Though the timing rules here are strict enough that this is very much a talk to a tax attorney months in advance strategy, not a last-minute move. 10th, and the one most people never think about until it's too late, planning the exit before you build the business, not after. When a business is eventually sold, how it's structured determines how the sale is taxed. A stock sale, an asset sale, and an installment sale can all produce very different tax outcomes on the exact same transaction. Some owners use installment sales deliberately, spreading proceeds and the tax on those proceeds across several years instead of taking one enormous taxable hit in a single filing year. For family businesses, tools like trusts and gifting strategies during life can move future appreciation out of an owner's estate long before a sale ever happens, which is part of why serious tax planning starts years, sometimes decades before an exit, not the week the deal closes. None of this requires breaking any rules. It requires knowing the rules exist: entity structure, retirement maximization, the QBI deduction, the Augusta rule, depreciation, income shifting, health-based accounts, strategic giving, and exit planning. Most of these are available to any small business owner, not just the ultra-wealthy. The gap isn't legality, it's information, and most of it just isn't taught anywhere. If this helped, subscribe for more breakdowns like this. And again, talk to a licensed CPA or tax attorney before implementing any of these for your specific situation, since the right combination depends entirely on your income, your entity type, and your state. Thanks for watching.